Let's get down to it. We've got February market stats that we are going to review today, and then we're going to, more importantly, talk about what is to be anticipated in the future with so much market information happening. This is an update you're not going to want to miss. Welcome to the February market update. My name is Alex Stewart, co-founder of the Market Distillery, and we are looking specifically at Northeast Florida today, the Jacksonville region, to be able to see what is going on in this market, to see the trends that are happening, and then also to look forward to what to expect as we come into the selling season that is summer. So on this dashboard, you'll see at the top, we have a market balance. This is where we take a look at months of inventory and we allow that to tell us who's in control of the market. Historically, 6 months has been a balanced market. A lot of people would argue nowadays it's more like 4 months would be sellers and buyers have equal power. And we know that whoever has power in this market, you're going to take very different strategies when you're looking to buy or sell a property. And now we are seeing that months of inventory is down to about 3.5. And this is interesting because in December we had 3.5. January we had 4.5. And now in February we're back down to 3.5. And the big change in that is due to the number of sales that are happening. It's not as much that inventory is changing. We'll see here that active listings are actually going down, but in January we saw a very low dip in sales that has popped back up, and that is why months of inventory is back down to 3.5. And this tells us, this 3.5 number tells us, look, it is still geared towards sellers overall, but buyers have more negotiation power than they did in the past 2 years when months of inventory was down as low as 1 month of inventory. So that is where the balance of the market stands. When we look at rates to start, this is going to help us to forecast into the future. We know that we've seen 4 months in a row of rate decreases, and then we saw 1 month of rate increases recently in February as rates went from just under 6.25 up to around 6.5. That's gonna put a damper on things. It can work in a couple different ways, though. It could create a sense of urgency. People that saw rates come down may look at that and say, well, I need to go ahead and act before they go back up. And in a lot of cases, that may not be an unwise decision. That may be something that makes a lot of sense. But we do know that will price some people out of the market in general, and I would expect to see that impact the market in March. Now, sneak preview, we already know in March, because of what's gone on with these bank crises, that rates have come back down, and we're now closer to that 6.25, 6.15 mark currently in the market. So, this is a fluid situation. It's very dynamic, and rates coming down because of this negative economic news, they're going to stimulate people in the housing market because people are going to have to buy a house or rent a property either way. And if rates come down, they're going to be more inclined to buying, in my mind. Now, as we look at supply, one half of the equation, again, as I spoke about, active listings are down, 4%. And it's always interesting when you export this information from the MLS, this is higher than what we see. Active houses on the market right now today, about 5,700. It's been in that 5,500, 5,700 range for a while now. That's not a lot of houses. And it is something that is going to keep prices elevated because there's just fewer choices out there. And you see this, the average sales price is up 1% in February. I'll talk more about the difference between average and median and how to look at that. But on average in this market, sales prices are still holding firm in general. We're up about 7% compared to the same time last year. So if you bought a house at the beginning of 22, all those rate increases happened, all the interest rates rose, you heard all the negative headlines in the media. you're still up on average on your property about 7%. And that is very good. The long-term average in Jacksonville is about 4.5% appreciation per year. So that's still very encouraging. Now, on the demand side, we're seeing a little bit of a sort of a mixed bag here. Days on market is up to 75 from 62. This is a 21% increase. And this is one of those red flags that goes up that says, okay, that is telling me that homes are sitting on the market longer. Closed sales, however, were up 27% from January. They're down 22% compared to February of last year. But listen, we're comparing against a market where rates were still 3% and now rates are 6.5%. That should be down. And at the end of the day, this 27% increase from January is very encouraging because it's saying people are getting off of the sidelines. So those are all sales that people went under contract in January, most likely, some in December, and they're closing in February. So that is sort of a lagging measure. But that tells me that people hit the New Year's resolution hard this year where they took action. They said, I'm going to buy a house this year. I've been pre-approved all of last year. I didn't take action because I was scared. It's not getting any better, and I need to go ahead and do something with my house because renting is not an affordable option either. So when I look at this, I see, okay, days on market are rising, but closed sales are also rising. One of those suggests that demand is falling off. One suggests demand is rising. And I think at the end of the day, when I look at this days on market, that tells me we probably just have a lower quality of home that is on the market right now. Either it's coming to the market with a price that's above where it should be for that specific property, and so they're having to do some price reductions, a lot of negotiation to make a deal happen, and that's taking a little bit longer. Or it is something where, you know, we're factoring in now homes that had to sit through the holidays, and maybe now they're going under contract, but they sat over, you know, November and December of last year, and that's just adding to the mix. So we'll see as we move forward. I would expect days on market to start to come down as we get into this summer selling season and buying season. I would expect closed sales to continue to rise. Average price typically rises. Typically, you do see more listings hit the market as well, but it's a combination of both buyers and sellers entering the market at the same time that sort of keeps the equation neutral. A lot more transactions happen because a lot of people put their house up, but those same people are also looking to buy, and there's more people looking to buy during the summer because the kids are out of school. So just a lot more activity happens. So in general, I look at this market and I say, this is a market that is waking up early in the year. It is a market that is already somewhat constricted on inventory. Typically, again, we start to see more homes hitting the market and inventory levels rising. There's more to choose from. There's a lot more sales that can happen from that. We're already seeing the inventory is not there. And this is the dilemma of people that have high interest rates that they would be moving to from a very low interest rate, and they just don't want to make that trade. There will be, as we look forward, some major market moves, right? We've seen some banking collapses happen now. I think we're up to 3 banks that have failed and another bank that's being propped up by some of the big banks. That is going to have a positive impact on interest rates. And the reason why is when people are scared in this economy or in this market, they take money out of the stock market. Things that can crash overnight, they take their money out of that and they put it into bonds. They invest in more conservative things. And when money flows to bonds, suddenly all these bonds that were, you know, offering 6.5 on the rate, and that's why you bought it. Now they say, well, there's a bunch of money coming in. We can offer 5.5 and people will still buy. That's why rates decrease when the economy has some struggle and some negative news. And so we've already seen this in mortgage rates a little bit. We would anticipate to see this potentially continue if there was greater crisis to occur. And I do think we are at the tip of the iceberg on this sort of banking issue. You know, there's 2 main things driving this. People that invested in crypto that made loans against it when the prices were really high, and now those loans are not worth anything, having issues, as well as people and banks that bought treasuries and made investments when rates were ultra low, and are now essentially dealing with the fact that rates have gone up and what they own is no longer worth what they thought it was. There's a ton of leverage in the system, meaning there's a lot of people that have borrowed money to try to get greater returns just because interest rates were low for so long. And the positive for the market is the Fed ultimately stepped in very quickly in one weekend and stimulated. They bailed out these banks. They said, look, we don't want a market scare. We don't want people to run the banks, and we are going to, make these depositors whole. The people that had accounts there, they're going to not lose any money. And not only that, for all these other banks that may have similar situations going on, you can come to us and sell us your investments, and we'll pay you money that is above what they're actually worth so that you don't have any issues. So in the short term, we expect interest rates to dive due to uncertainty and fear. The long term, though, it is an inflation challenge. This is more money printing, more stimulus. This is what we call a moral hazard, where people are now incentivized to not necessarily do their due diligence on investments, to worry about if they're making wise choices with their money, because the precedent is set that the Fed is going to bail you out if you're big enough so that it avoids a greater issue. And so, again, we look at these windows of opportunity. You may have a window of opportunity here the next few months to make a move in real estate, both buying and selling, to sort of max out what you can do before potentially inflation continues to rear its head, and that would ultimately have a negative impact on rates, limiting the number of people that could buy properties. And that would ultimately, it wouldn't crash prices, but it stops the ability for transactions to really happen. And people are just going to sit tight because they're owning houses that they live in. If they're rental properties, they're probably cash flowing because rents have gone up a lot. And that gets back to the grinding to a halt that I spoke of many times before. This is not something where I expect real estate to fall off a cliff. This is something where real estate potentially is going to grind to a halt because buyers won't be buying and sellers won't be selling, and so there's not going to be too much of a market there for anybody. So with that, we'll wrap up on this February market update. We'll have more information coming soon. I anticipate us to be launching our membership ideally in April, and we look forward to seeing what the market brings us and finding the opportunities that are available due to what's going on. I hope you have a wonderful day. Happy St. Patty's, and we'll talk to you soon.